Simon, obviously this high inflation environment, very tough for smaller companies.
Yes, it can be. I mean, we say high inflation now. If we look at the data coming out of the US, even yesterday, it's down to 3.3%. You know, we're kind of in getting back to normal realms. But for smaller companies, you know, the reason we are overweight the US is because when we're looking throughout the world for these extremely high quality small and mid-cap companies that we can find and hold on to and let them compound over time, I mean, the US is a wonderful playground for us because smaller companies tend to be more domestically focused. I mean, it's obvious. You know, big multinationals obviously are a lot more diversified in geography, region, but also product. In smaller companies, you tend to find that they're more focused in geography and product line. And so if you find a company that is more focused, but in the US, you have got a much bigger connected domestic market than you have pretty much anywhere else in the world. And so that is why, for us, finding very high quality companies that are growing fast in the US have the potential to keep growing for so much longer because their domestic market is so big.
Thank you. Jamie, I'm really interested in your view on the US.
Yeah, sure. So I'll just split it into three components. So let's talk about the economy briefly, let's talk about elections, and let's talk about the equity market itself, because obviously that's very distinct from the economy. So on the starting point, you know, economically, the US is a powerhouse and will remain so. And I think we're believers as well in a soft landing here. You know, there's mixed economic data out there. Inflation's moderating. Industrial production seems to be troughing at slightly lower than desirable levels, but troughing nonetheless. Consumer activity actually we think starts to kind of pick up here. The issue we have is that soft landing narrative for us is consensual. It is not me alone that is sitting here expecting a soft landing. And so when we bring it to the equity market, we have the S&P at all-time highs. We have the S&P trading on the biggest premium it's traded relative to my core region, Europe, that it has in the last 20 years. So the starting point on expectation is high. We are underweight the US and are happy with that exposure. And the kind of black swan event here, of course, is the election coming up on the 5th of November. Everyone, I think, again, the consensual opinion here is that some sort of a split result is a positive. A Republican, you know, a Trump win would be a big negative because of the potential for stagflation with tariffs. We actually would look at that and agree with those two comments. However, a Democratic clean sweep as well brings its risks to the equity market. Any form of higher taxation to the corporate world will be seen as a negative, especially given the valuation highs that the US market is trading at.
Great. Jamie, I'm going to come back with you right now. Okay, we've done the US. How about other underweight and overweight positions in terms of countries, perhaps even sectors?
Sure. So this will bring me back to my pet subject, Europe, which I think for 20 years I've now been trying to extol the virtues of. 20 years ago, that was pretty hard. 10 years ago, a little bit easier. Today, it's far easier. I think that the opportunity set in Europe has improved dramatically. We still have our political issues, as we can see. We'll have more in 2025 from Germany. But, you know, from a company point of view, we have a much better opportunity set to invest in. We look at Europe and we think there are global champions there that are suffering in valuation terms purely because of having the wrong postcode. So we like Europe. Where else? So we've got sleeves in Pan-Asia and we have sleeves in Japan as well. Both of those regions, again, we are overweight. So for Japan, okay, in the short term, there's some technical issues with the unwind of the carry trade and equally hard to understand technicalities. But from a fundamental perspective, this is a market that has adopted a far more capitalist approach over the last 10 to 15 years. So ever since corporate governance reforms in 2014, 2015, it's a region we've wanted exposure to. We like the fact that return on equity has become more of a focus. We like the fact that the quality of boards has improved. Cross-boarding has decreased. Independent directors has increased. So Japan we like, and then with Pan-Asia, there's several core attractive growth themes that keep us invested and overweight in that region. So those are broadly the kind of country regional weightings, and I'll be very brief on the sectors. We like consumer discretionary, we like financials, we like industrials. Those are sectors that for us meet our twin objectives of capital growth, consistent capital growth, and growing dividend over time.
Thanks so much, James. Not surprised Europe featured there, but we've just actually been talking extensively in this room about Japanese corporate governance with API Japan opportunities. Simon, how about you in terms of sectors, countries? Where are you underweight, overweight here?
Well, funny enough, our second biggest country overweight is the UK. And that's not because we have a home bias, far from it actually, but simply because over the last few years that we've been operating, as I keep saying, we're looking for these fantastic companies, and we have found some in the UK at very discounted valuations relative to global peers, simply, again, because of the postcode they're in. I like that phrase. So this includes names like Halma and Diploma, which are fantastic companies. Diploma, since we owned it, is up 4 times, and yet, as we know, the UK market's done hardly anything. So stock selection is important, but for us, we've been able to find those companies. And then in the sectors, we've got a very concentrated portfolio because what we look for in companies is so specific. We're trying to find those companies that just compound and generate wealth over time. And there aren't that many that can sustain that over the long term. So what we have discovered over time is that we've only got a 34 stock portfolio, we have become more and more specialized in what we're looking for. So even if I say that we focus on sectors such as consumer, industrials, technology, and healthcare, even that sounds too broad compared to what we're actually doing. What we're really doing is finding very niche subsectors within that, which we just drill and look at and go over and over again to keep finding the same type of company situations and types that we've had success with in the past, and we know will continue generating double-digit growth into the future.
Well, I'm pleased the UK featured there, and very interesting to hear more about your process and how you repeat that. Craig, how about you on the sectors and countries you underweight and overweight?
Yes, I'll throw in my caveat again, that this trust is run so that we don't have big positions on geography or sector basis, so that stock selection drives everything. That said, we do allow some of those to happen from bottom-up ideas that are being generated. So we are overweight the UK as well, albeit in our portfolio that's actually driven by some large cap names that are actually quite global in nature. They're not really UK companies per se, they just happen to be listed there, but as a result they look quite cheap relative to some of their global counterparts that are listed on different exchanges. So we do have a few of those, the likes of Diageo and Unilever and those sorts of companies, GlaxoSmithKline. But perhaps a more interesting one from a country perspective is Japan, given that there was a session on it in here before. And the reason I think that's quite interesting is because we did actually introduce a Japanese specialist manager into our portfolio. We normally have mainly global managers, occasionally US managers, given it's such a large part of the world. But we actually put in a Japanese specialist. And that wasn't because we took a top-down view that Japan looks cheap. As it happens, we think it does look reasonably attractive from a top-down perspective, and the yen looks particularly interesting. But that wasn't the reason. In fact, we were slightly underweight Japan. You tend to be a bit structurally underweight with global managers because it's a lot harder to invest in Japan. You often have to speak Japanese in order, certainly if you're going down the cap spectrum, to companies in that space. But what we really liked about Japan, despite the fact that we were slightly underweight, was the fact that there was reform. And so the stock exchange is actually putting pressure on companies to think about shareholder value more and more. And so, if a company's on a price to book of less than 1, they have to put out their plan as to how they're going to create more shareholder value. And we've got a manager that we've liked for many years in Japanese mid-cap space that had always been about shareholder value, working with the boards on how to improve that. And we thought there was a massive opportunity from stock selection outperformance within Japan building up because of what's changing in that market. So we've gone from a structurally underweight position to being slightly overweight, but more importantly, thinking there's a lot of stock selection potential in that space as well. On the industry side, not major positions, as I said, we try and keep those out. But we certainly have ended up from being slightly underweight technology, Magnificent Seven, to being a lot more underweight just very recently. Same with semiconductors, just with the price runs that have happened in that space. And so therefore a bit more spread out amongst other sectors, finding ideas everywhere, really where valuations haven't moved up like they have in some of those sectors. So be that in the consumer space, I mentioned Diageo in the UK, be that in industrials, things like Safran or Airbus in the aerospace sector, construction, Vinci. So there's lots of these companies that you can see quite interesting growth prospects that are that aren't getting the press that some of the technology and semiconductors are getting, but actually they're sitting on much lower valuations and look a pretty attractive prospect going forward.
Thanks, Craig. Interesting both of you seeing the opportunities there in Japan. I'd now like to start taking some questions, because this is, and I can see there's a question right at the back there. Is that right, Megan? There is. We've got to get through as many questions as possible here. That's what it's all about you.
No.
Has the question disappeared? No. There's a gentleman right here.
I've got a mic here.
Okay, let's go over there then. Sorry, I've got a light switching right here.
Thanks very much. The Europe question baffles me, because the Northern European economy is in a terrible state. France and Germany, Germany's PMIs are in a terrible place, yet the DAX is bumping along all-time highs. Can you explain that, please? And particularly, can you explain why that's an attractive investment scenario? Because it looks terrible. It looks like a sell to me, not a buy.
Well, that sounds like a question with Jamie written all over it.
Happy to address. Yeah, no idea actually on the DAX. I mean, it is quite amazing, isn't it, the progress it's made. I mean, the issue with Europe, and it's always the issue when issues around China rear their head, is that the revenue exposure is that much higher in Europe than it is in other markets we can invest in outside of China. So Europe as a whole, the revenue exposure to China is about 15%, and that is double the exposure in the US, for example. So that is a big issue. So what is the bull case here specifically with regards to Germany? Germany still has a big industrial, kind of short cycle and automotive heartland. And what we're seeing here is a moment where we've seen real structural weakness in those sectors, partly due to the overriding industrial environment, but to a large part due to Chinese kind of exported deflation and Chinese economic weakness. And what have we had over the last couple of weeks? We've had the sniff of a chance that China is willing to start addressing the issues they face, debt, deflation, and demographics they possibly can't do a lot about. But any sort of kind of big bang moment from China will have a big implication for Germany, a big implication for Europe. And I think the DAX, to a certain extent, is starting to price in a bit of hope on that. So, even with the autos companies still warning, backwards looking on market conditions, the share prices seem to be finding a bottom. So I think that explains that DAX performance in the short term versus the reality of the tough environment that we've seen over the last couple of years.
Okay, I think we fully answered that one. I've got a gentleman right here in a beige waistcoat, I think. Great.
Thank you for the description. My question follows on from your answer, which is China. And I just wanted to know what the panelists' positions are on China and whether they've changed over time and the explanation as to why their positions, whether they're underweight or overweight on China.
Yeah, I think that's very interesting, particularly with the fiscal stimulus. It's been a bit of a roller coaster ride in the market. Craig?
So we've been pretty underweight China. I haven't had a lot in China for a while now. We did if you go back a few years ago, but not for the last few years. Although we brought in a new manager, Arga came in quite recently to replace Ben Whitmore who was at Jupiter. And they do have some exposure in China, and they're playing stocks that they think will do well almost regardless of what China does, just on how attractively priced they look. So some insurance companies, for example, like Ping An in China. But we're certainly not overweight overall. We're still probably about neutral. But one manager's playing that. Most of the other managers have not been in China.
Okay, any other comments on China, managers?
Yeah, for us, I mean, we're developed market only, so we don't have any direct exposure to China, but we do certainly have companies with exposure to the Chinese consumers, so it's something we watch very carefully. Obviously, China's got some unique issues with the property sector blowing up and the knock-on effects to the consumer confidence. And so where this might really help us is the fiscal stimulus and the return of some degree of consumer confidence. And areas, in particularly the luxury space, which have up to 30% exposure to China, I think are now looking very attractive because we've got that combination of the last 12, 18 months or so of consumer weakness in China with the potential benefit ahead of us. So for us, we're actually getting a little more excited.
Interesting. Right, questions. Megan, have you got a question? Sorry? Jamie,
yeah,
have you
I'd
got
love
more
to.
to add?
Yeah,
Jamie's got
love
more
to.
to add on China. Hang on. Go
Yeah,
ahead.
love to espouse on China. So I think, well, we have been underweight and we remain so. From a purely regional perspective, we invest through H shares in China. So underweight exposure there. I think it's very dangerous to assume that the fiscal or monetary or combination response is over. There are very serious structural issues, that is undeniable. But the comparison that people are making with decades ago Japanification, for us, is actually unjust and risks complacency in that. Yes, there is a lot of debt, and yes, there is demographic problems, but we believe that some of the measures they're putting in place have the opportunity to start to change the narrative. So how are we reflecting that? Well, if I go back to my regional exposure, we've started to become much more interested in some of those. We talked earlier on Germany, so some of those German plays on industrial plays. Siemens is a good example. And another example of a company that 20 years ago was pretty much uninvestable. Today it's very much investable and has a big Chinese exposure, so something we're starting to play.
Okay, thank you very much for your question. Megan?
I just wondered what the panel thought about the investment market and opportunities in India now under the new coalition government. And it's quite interesting how India seems to be able to have a relationship with everybody in the world, unlike most countries. For example, I mean, they've got relationships with the US, Russia and China, which I think is quite interesting and obviously bodes well for them in the future if they maintain those sort of relationships.
Yeah, I think that is a very good question. Our Indian investment trusts have been performing extremely well, and I will be moderating a panel on them later today. India, Jamie?
Yeah, happy to kick off. So as China is our kind of obvious underweight in the Pan-Asian region, India for us is our quite big overweight exposure. So structurally we're very positive on India. I won't comment too much on the political environment. I agree there's been some kind of smart kind of geopolitical play there on the world basis. But from an economy point of view, we really like infrastructure in India. So we can see, you know, a multi-decade opportunity that we're expressing through an investment in a gas networks business, Gale, for example, or power grid, you know, a grid business, electrical grid infrastructure in India. And again, there's some consumer plays. We like the banking system as well, so we like the kind of the theme of financial inclusivity, especially across Asia, but especially in India. So very positive on the region. It comes at a high valuation. So we have to accept that, but we think the risk reward is pretty good.
Great. Craig, Simon, comments on India?
I haven't really got much to add, to be honest, on the overall view on India. I would say we've got one manager, GQG, which is run by Rajiv Jain, who's always been a big investor in India, and he does have a decent exposure to India. So overall, we are slightly overweight, but that hasn't really changed for some time. It's very stock specific.
And we have no exposure to India.
Okay, moving on then. Next question. I've got Peter Higgins right here.
Thank you very much. Thank you all in the panel. I've got a question for Craig with regards to the mega caps. Looking away from the mega caps, where are you finding and seeking value, deep value, where you can see lots of intrinsic value?
Yeah, well, as I say, it's really been across the piece. So we've got exposure to something like 95 industry subsectors across the portfolio. The way we structure the portfolio is genuinely to try and create the weightings to the managers such that nothing, it looks a very dull portfolio from a top-down perspective. So you look at it and you go, well, you look pretty close to benchmark country by country. You look pretty close by the major industry sectors. In cap spectrum, you look reasonably close. Now, to be clear, in market cap, we've always had a slight bias away from the mega caps, just generally do. If you ask people to, and just a bit of background, the managers we have in our portfolios, we tell them we only want their best ideas, so just pick a maximum of 20 stocks. If you tell people to do that, it's unlikely that they're going to stuff it full of the largest companies in the world, the ones that have gone up the most, are the most covered by the brokerage community and the like. So we've always got a slight bias to that, but we try and manage it so that that doesn't trip up the portfolio too much. And of course that's helped us. It's been a headwind having the mega caps drive everything for the last few years, but we've actually managed that by the weightings to managers and having some managers that had significant weight to those. Pretty much even the ones that were significantly overweight, the Magnificent Seven, have sold them in the last couple of weeks. I mean, it's literally the last couple of weeks. And so our exposure, we've gone from always being about 2 or 3% underweight the Magnificent Seven to about 10% underweight the Magnificent Seven. So it's been quite a shift in recent times, but that has been pretty broad across the piece. I wouldn't say our cap distribution has changed from, you know, the mid cap, large cap. It's really just that 7 stocks has then just been a bit distributed across the piece.
Thanks so much for your question, Peter. Just check, managers, no more comments? No? Okay, moving on. Next question. There aren't any questions. There's one question there. Okay, we're going to come to you. Just 1 minute.
Hi there. I was just wondering, what do you think are the biggest inhibitors to an improvement in the UK market, both in, and particularly with a view to its higher percentage across the world indices?
Interesting question. Sort of what's holding the UK back?
I mean, I think it has to be uncertainty. Uncertainty in the political environment, uncertainty in the taxation structure, I think uncertainty in many aspects. But we have great companies in the UK. Sometimes when you look at an index level, it isn't so attractive from our perspective in terms of the construction of that index, particularly the FTSE 100. But when you look at particular stocks, we've got some amazing stocks with great corporate governance, fantastic management teams, and great opportunities. And as I said earlier, trading at very attractive levels. But us, like you, are just waiting for those to be recognised, and I think we're going to have to wait a little bit longer until a lot of this uncertainty is unwound.
Any other comments? Jamie?
Yeah, I think I'll take a less, well, on the politics. I actually think that sitting in this room, sitting in London, reading the papers we read and listening to the podcasts we listen to, it's quite easy to think, okay, we've had some positive change. Oh no, wait a second. You know, we're back to issues of, you know, where Keir Starmer's, been to some concert or what clothes he's wearing, etc. I think from a world point of view, looking in, the fact remains that we have probably a far more stable political environment. And I think that will be, you know, we have a majority government that has some credibility and power, and I think that will help. I think where we struggle with longer term in the UK is the sad fact of global asset allocation and the increasingly kind of regional, I don't want to use the word irrelevance, but the UK's relevance is diminishing for global asset allocators. And I think that is a headwind that's got to be fought against. How do you fight against it? It's always the companies itself. We need innovation, we need great growing companies, and we need structurally appealing companies. And that's the onus is on all of us to invest in the right way in the right areas.
Thanks very much, Jamie. Questions? There's one over there. Okay, great. That's the one I'm looking at.
What are your views on currencies, and do you actively manage them?
Currencies. Who's managing their currency risk? No one, maybe. I don't know. We'll see. It's quite quiet. Right?
Yeah, no, so we don't actively manage the currency in the sense that we don't use hedging, don't use derivatives to take a view on currencies. we basically follow the currency breakdown of the benchmark roughly, and then if we're overweight or underweight, that will come inherently with some currency related to it. So when we're challenging our stock pickers about the companies they're owning, we're trying to understand whether they've thought through the implications of the currency of the country they're in on that stock price. We spend a lot of time doing that. I talked before about the fact that the yen looked reasonably attractive. We will be having those conversations. And of course, being a UK trust, we think about our borrowing and whether that should be in sterling or in euro, for example. But generally, we're not managing actively the currencies in the portfolio.
Jamie?
Yeah, so on bankers, a very similar approach. The only thing I would add is that maybe more out of hope than reality for our positioning, but we're in a period we think of, of US rates coming down and potentially US dollar weakness. Generally, that favors, kind of emerging markets over the US. And so I think our overweight exposure to non-US is something that we think is well placed in that regard.
Simon?
We don't manage currency. And actually, although we've been talking about regions, we don't particularly manage our overweight and underweight regions. With such a concentrated portfolio, it's very much bottom up. So while we will tend to have the largest region being the US for the reasons I spoke about before, other regions are very much built bottom up. And so that is not there's no overriding consideration that we take on that.
Okay, next question. Is there one right down there? I think there is. Gonna catch my eye.
For the last, I guess, since 2008, really, European banks have been some of the least popular stocks possible. I mean, they've barely met their cap rates. But in the last year or two, we've really seen that switch around. They're very hot, especially in value circles. Just wondering what your thoughts on European banks are. If rates start to come down, do they lose all their luster again? Thank you.
Anyone? Yeah, Jamie.
Happy to kick things off.
Yeah,
European banks, favourite subject. So, for years and years, awful investments. What's changed since the global financial crisis? Far slower than in the US, but a recapitalisation. So these banks, the foot that they start on is far stronger basis. So banks have moved from being 40 times levered and completely undercapitalised. Crazy thinking about that now. 40 times levered back in the day, back in when I started, to now more like kind of 10 or less times levered, far better capital base. We think also in general there's been an improvement in the discipline of lending across the board. We can see that in some of the holdings that specifically that we have. So UniCredit's our biggest bank holding. That's been a fantastic success story. And incidentally, on this point of European banks, there is a very crucial event happening at the moment, which I think says a lot about where we are in Europe, which is the UniCredit approach on Commerzbank. Commerzbank is a bank that reminds us of the banks in 20 years ago. This is the bank that has not made a return on equity above its cost of equity for as long as I've invested, 20 years. And it cannot do so even with rates high. Consolidation makes sense. Will the EU allow it to happen? Will the Germans allow it to happen? Will the Italians? That's a very important event for Europe. So we're more positive on banks than I suppose we ever have been in Europe, and think there's a good basis for further outperformance, whether rates come down or not.
Okay, I just want to know if anyone else wants to comment on European banks.
We don't have much exposure.
We don't own any.
Okay, let's have another question instead then. Max.
Why don't UK companies create value for shareholders by emigrating?
By listing elsewhere, yeah?
Yeah.
Listing in the US or somewhere else.
Australia, HSBC,
Sure.
Hong Kong, AstraZeneca to Sweden.
Yeah. Anyone actually want to answer that question? No?
None of us move, but
I think to a certain extent they are. We have seen, whether we look at companies like, I'm kind of choosing two with an Irish flavour in a way, but CRH, or we look at Smurfit, which through a US acquisition has got itself a US listing. There is a tendency towards this happening at times of extreme valuation disconnect. And in the UK and Europe more broadly, there is that environment at the moment. So we do expect more will do so. However, it's not a one-way ticket. It's an arbitrage. It's a point in time when valuation gaps are very wide. Companies starting to think about listing somewhere else actually helps close that valuation gap over time as people start see the arbitrage in motion.
Okay, any other comments on that?
Well, the only thing I'd say is that don't underestimate that the new government is aware of a lot of these things and is spending quite a lot of time with the asset management industry, with the insurance industry, with corporates, trying to understand what things they can do to help with this. I mean, time will tell whether it leads to anything, but there's definitely a desire to address these issues.
Max, as you know, we are trying our best to revitalise the UK market, and we have been talking to the government on various issues, for example, stamp duty, and we think that would be very helpful if they abolished it.
I think the biggest issue actually is the newer companies coming to market and choosing to list for the first time in the US rather than the UK. I've been talking to CEOs of private companies who are being wooed like you wouldn't believe by the US. They are invited constantly over by the New York Stock Exchange with very extravagant events with potential investors, and they are constantly being asked, invited, and shown around the country. In the UK, these same CEOs said, the London Stock Exchange has not even contacted us. We were asking, in fact, the CEO actually has a preference to list in the UK simply because he is British and he wants to, in a slightly patriotic way, bring these. It's a technology company, a very fast-growing technology company, one we definitely want to keep in this country. And he said the only thing keeping me here is my own patriotism. Whereas if I was being purely commercial, I'd be going to the US.
Yeah, we've got to make the UK a more attractive place to list, quite honestly, and we've got to make sure we woo these people and bring them in. I've got 49 seconds. I've got time for one more question. I'm just saying, because obviously you've had one. Is there anyone? Megan?
Hi. The topic of the next decade, AI. Beyond the hyperscalers and, the Magnificent Seven, and the lot, what companies in your portfolio actually are looking at that, and do you actually ask them questions around what they're doing in terms of transformation?
AI.
Yeah.
Simon.
So we have had to think a little bit outside the box in getting exposure to AI. As we all know, it's clearly a growth industry for potentially a very long time. Are there parallels to the dot-com boom, potentially on valuation in some areas, not everywhere? But can we see this technology being big in the future? Absolutely. But in small and mid-cap publicly listed markets, we have to think a bit more creatively because the very successful AI companies today are either large or private, okay? So we've got to think differently. The way we have done that, though, is finding companies with potentially tangential exposures to AI. So I'll give you a couple of examples. One in particular is a company we found in Italy, obviously a small company which is an IT consultant. They have very long-standing blue-chip clients in an almost subscription fashion, but they are tasked with deploying the newest technology and IT into these very large blue-chip clients whenever it is developed. So essentially, whoever develops the best AI technology, this company will still be employed to deploy it. And it's all custom. They do their own coding to incorporate this technology into the companies, and increasingly their work is focused on incorporating AI. That's one example. Another example are some data analytics companies which we own, and they are using AI in two ways. The traditional AI, they are using in terms of cost-cutting still. So they are obviously, they can use algorithms to work out the best way to allocate resources within the company. But in terms of the new generation, generative AI, they're increasingly using that for coding, writing code, making a lot of processes more efficient internally. That's on the cost side. But there are very few companies, I can only think of one, that is actually deploying generative AI in the product space, so new products. And that is, again, a data analytics company. And this particular product I'm thinking of is focused on insurance fraud. So they've created an AI product that can detect insurance fraud as people transact through the world. But that is very, very nascent, that people are actually creating revenue-producing opportunities using generative AI.
Interesting, Simon. Now, we are right out of time. Jamie, do you want to add anything on AI?
I'll be as brief as I can. So the hyperscalers create an ecosystem. That ecosystem is very diverse across a number of different sectors and regions. we can play this through a number of different things. Semiconductor equipment chain is an obvious one. Construction, electrical engineers is another one, and grid companies. We have chosen to play it through the kind of proliferation of value through the system. We believe that the highly valued, most obvious plays, notably in the US, are probably kind of past their best in terms of investment for us. Play the smaller exposures.
And I think, given that I'm giving a speech next door in 2 minutes and I've got to change microphones, I'll just say we've got quite a few.
Okay. So if you want to hear Craig's view, you need to now leave next door, because we're keeping him busy today, working him very hard. Ladies and gentlemen, thank you so much.